What are the various metrics used to assess investment property performance besides yield on purchase? And yield is the annual rent divided by the purchase price. And in Perth, it's anywhere from, say, 4% to 7% for units. When I do our strategic portfolio plans, we do what we call a trifecta review of a property where we look at the suburb, how that's performed in the past.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to Perth Property Insider. I'm your host, Jared Mann, and today I'm going into a lot of the questions recently getting asked on the Perth Property Investment Facebook group, or at least I've pulled out the ones that I think would be interesting and can help me give you another opinion and some insights on things. So when you get to a similar position, you'll have this in the back of your mind, or you might be in this position right now or have a friend that is. So feel free to pass the episode on. Now let's dive into things, shall we? First question is, how long does the general Perth surge have left in it? Will peak values hold? I am starting to get asked this question a bit because people are feeling that Perth's had a very big run so far and they're wondering how long is left. Well, I was confident that the next year was solid ahead, and it is hard to see beyond that. So I also looked to get input from other experts to form my opinions and view as an investor myself. And we were lucky enough to have renowned researcher John Lindeman along to the seminar that we ran last weekend, and he absolutely lives, sleeps, eats and breathes this with data algorithms that he claims are 93% accurate in their predictions, back-tested over long periods of time. John ran the ABS research division for property for a while and also was the head of research at Residex, so comes from a very esteemed background, and I've certainly welcomed the chance to have him over every year or two to chat to our clients, and it was a fabulous seminar that we did. It was eye-opening for me, and by all accounts, the session that I did was well received by people, and we got lots of good feedback on that too, so make sure you come along to the next one. But what John had to say, in essence, around this topic was that he sees that the cycle's got at least 3 years to run, and that growth is now going to move stronger up from the lower end houses where it is now. And we've had, crazy levels of growth over the last year, annualized at around 32% for the lower end. And I'm talking sort of probably 700,000 and less. And he's predicting that it's now going to move into units, which makes sense because they're so undervalued. And I did a few episodes back on what would I buy if I had only 550,000 to spend. And in that episode, I did a very deep analysis on the gap widening between units and houses now being $210,000, which is the biggest gap that there's ever been. So there's a lot of value represented in units at the moment. And John agreed with that. I'm starting to see the market heating up for units, villas and townhouses, anything that's a more affordable option than a house. So he believes that end of that type of property is going to surge greatly over the next year or two. And then he's suggesting that with the lower end of the market now having had very strong growth compared to the other segments of the market, he's seeing that the middle priced areas represent a lot more value, and things are predicted to move into those areas more strongly. It doesn't mean that the bottom's going to stop growing entirely, because affordability is certainly driving things in that segment of the market still, and will keep prices up and continuing to increase, but probably just not at the pace that they have been. And then once it moves into the middle, those people are going to get more for their properties than they thought, enabling them to upgrade. Those at the lower end are going to upgrade into the middle going to upgrade into the upper end. And I think it'll be a real sign when we see the upper end having significant growth that we're nearing the end of our overall cycle. And John thinks that it's going to take at least 3 years for that to occur. And even at the 3-year point, he's sort of thinking that the upper end will still, about a third of the overall market will still be growing very strongly. The total market, third of the total market will be growing strongly. So different suburbs are going to represent better value and more growth potential as time goes in the cycle. At any one time, we're always looking to buy into areas that represent more value at an individual price point budget for someone. So even if your budget's towards the lower end, once an area becomes overpriced and represents greater value than other lower end areas at any suburb, we would then look to target those that represent better value and still making sure that they've had a longer term history of better growth back looking as well. So hopefully that gives you some insight as to what's ahead. Will peak values hold? Well, I think that's really going to more come down to how soft our economy landing might be and whether we sort of can sustain and continue. Probably going to depend what happens globally with the need for our resources and, what also happens with interest rates. So what I'm thinking as well is when we look ahead, interest rates are going to hit their peak at some point, probably at the end of this year, next year. You can imagine what that's going to do when people realise that we're at the top and potentially even start coming back. That's really going to kick the market into a whole nother gear. And I think that's going to really surge things in Perth, not let alone around the country. So that'll be another sort of key point, a phase point. And I'd really be trying to get in before that happens because I think it's going to go next level. And if we think it's hot now, it's going to be boiling by then. So will values hold? Well, it's going to depend probably how far we overdo things and how soft our landing is with the economy and sort of overall availability of jobs and what that does for population growth. So as the population growth continues, if the jobs continue, then that's going to really soften our landing, and hopefully resources and other industries can be held up to support those jobs and keep things with a really solid foundation and fundamentals. So next question. That was an interesting one, wasn't it? Next question. If we are asking someone to vacate the property in WA, what are our options? The lease ends in November 24. And I thought I'd cover this one because I do get asked it quite a lot. With the housing crisis, many people want to move into their homes if they're struggling for a home themselves. You know what? Some people are considering moving into their investment. Might have been their home originally. They rented it out. And some people are going back to it. Other people have been waiting to sell, taking advantage of the market being up. So they might want to get the tenant out, do a number of things to present it at its best. It's pretty hard to repaint a whole property when the tenant's still living there. And many people also have things happen in their worlds where they just need the property sold today. They don't want to wait until, towards the end of the lease. And look, if the tenant was presenting well and it's not going to hurt our selling price, we'd normally look to sell 2 months out from the lease. So this person's lease is up in November. So that means we'd look to sell in September. September's otherwise a pretty good time with just going into spring. So if they've got great urgency to get the property sold and get the money out, then the kind of things that you can look into is that it's worth knowing, first of all, that the lease stands until that lease end date. So you can't, when you've got a fixed lease, you can't go just finishing it because you want to. You'd also have to give them a minimum of 30 days notice to vacate at the end of that lease. And what I'd suggest doing if you did want to get in there sooner is let the tenants know your intentions, potentially let them know your reasons for selling as well, especially if that's going to make them more compassionate to the situation of why you're doing that. And you can also let them know that if they move out earlier with, say, 2 to 3 weeks notice, you'll allow them to finish up the lease without any break lease fees. And that way they can start looking, they can take their time about it, potentially they can find the right property, and then they can give a 2 to 3 week notice. And many will do that when they know that they have to move later. They'd rather take it to being within their control, within a time frame, and then not have to potentially pay double rent as they would if they'd moved towards the end of their lease finishing up in November. So if that's not fast enough, if they're not motivated enough by that, you can see how that tracks for a couple of weeks. Are they actually looking? Are they making applications for properties? Is your property manager getting reference checks or not? Have a chat to them, and then you could look to potentially speed things up, especially if your situation's urgent and you need to get into the property. We could look at compensating the tenant if they moved out by a certain date. So you sign an agreement saying that you'd credit them certain amount on vacate, and what we typically do with that is $800 to $1,000 to cover their moving costs. It's a nice sort of amount that makes sense if they move out by X date, and that puts some urgency around it, gives them a sweetener for moving out, and if they wait till the end of their lease, they're not going to receive that money towards moving costs, and that certainly would help motivate them in that overall situation. Now, if that's still not enough, I've had owners in the past really urgently need to get into properties. It's really just whatever you can negotiate to pay the tenant for that inconvenience of moving out earlier. And obviously, if the lease end date's further away, we've got some tenants, and we always sort of hesitate and advise against signing longer than a 1-year lease. Some of our owners, despite our suggestions, go and sign 2-year leases and then decide 6 months into them that they want to sell the property. And that does make it very hard because we can't sell it to home buyers. They're not going to be interested. We're more limited to selling it to investors, which is more possible now than it has been at any point in recent history. So investors are certainly out there, and there's enough of them to create competition and, still get a good price. But ideally, we want as many buyers to be able to purchase the property and interested, and that means giving, and it's possible to give vacant possession to a home buyer, have those home buyers in the mix along competing with the investors. So that's going to get the best price that we can. So hopefully that gives you a much deeper look at all the different options and considerations when we've got a fixed term lease and you might want to get in there earlier for whatever reason. Now, next question. Someone commented here saying, we're all happy about people buying and making profit, but can we all agree most people are interested when is the down market coming, please? At least some sort of relaxation in price, maybe 2025, they're asking. So I share this question, and I guess it relates into my answer for the first question above on how much the cycle's got to go, what sort of growth there might be ahead, and is the market going to hold when it gets to that sort of price? And I share this question because I am hearing more people with what I would consider more of a poor mindset thinking this way. I mean, I can understand that allure of if I just wait long enough, prices are going to come off and it's going to be easier for me to get into the market. But I think you really need to look at your mindset and change things up. And that's why I'm calling it more of a poor mindset. So no offense to the person asking the question, but I guess the purpose of this podcast is to give you insights into my mindset and what I believe you need to have to go about creating wealth and improving your life. I'd suggest that you more think about buying a property to invest in over the long term. And to do that, I always suggest that you buy a property when you can, not always when every condition in the media or the market is perfect. So it's very easy to find obstacles and objections, and I can think back to the different times when I've bought property and how uncertain the conditions are. And if I hadn't bought the properties then, there's always something else over the horizon that could put you off. And I've benefited tremendously, not just in this cycle, but in previous ones where I've really just bought when I can. And so if you can buy now, what's holding you back? I guess maybe the fear that things are at their top and are you paying too much? Well, I don't think they are. And I think that it's going to be much more expensive before the market goes flat. And if it does come off, I don't see us ever being lower than the prices that we are now. So it really is speculation with a very low probability in my mind if you're waiting for prices to be lower than where they are now. And I just look at what's the greater probability. That's a really low probability. I think the greater chance is going to be that they'll be much higher in price. We'll get to a peak, might come off a little bit, but you're in the market, you've bought when you can. What about what you're missing out on if you do sit on the sidelines and wait? You get to 2025, oh no, it's still too hot, I'm going to wait. 26, 27, the market passes you by, you can no longer get in. The flat cycle doesn't really see much of a decrease potentially, and you're out of the market. Meanwhile, if you'd entered, you could have made use of your equity by the time you get to that point. when the market turns around, you can use that equity to go and buy a really great buy, because it'll be a buyer's market whenever that point comes, and you could have increased your portfolio instead of thinking like a poor person and really looking at I'm always thinking about expansion, not retraction and sidelining myself. So it also affects your motivation as well. So if you're just going to sit on the side, is that going to motivate you to keep saving and one day finally get into something? So I find that continuously moving forward, taking momentum, saving, looking at my next goal, making those steps, and if the market did turn, I'd have the equity then to use to make advantage of it. So hopefully that gives you some insight, and good luck with whatever you decide. Next question. I bought a house in April 2023. It's increased in value by about 50%. Nice. I plan to develop in the next 1 to 2 years. What can I do in the meantime? My interest rate is 6.1%. So interest rate pretty good. So yep, you're not going to get that lower than that at the moment. With this extra equity that you've gained, can you use that to develop now? And the question, I guess, to ask deeper on would you develop now is, A, can you get finance? B, can you use the equity to contribute towards that loan, the equity that you've already got in the property? And most importantly, C, does doing a development stack up, and is that viable at the moment based on current house values, not counting on future prices at all, and current building costs? And I'd speak to someone like Anton Flynn, who we've had on the show previously from Subdivision Experts. I'd chat to him about doing a feasibility. Yes, he charges for it, but it's going to be worth paying the money to see whether it's going to stack up. If it doesn't stack up, and it is hard at the moment for developments to stack up, it's starting to change a bit as established prices come up and build prices have sort of hopefully flattened now, and time periods are a lot more reasonable. So it's going to start to make sense over the next coming 1 to 2 years. So you may have to wait longer. I'd look at creating a overall sort of plan for what you're going to do and looking at what your borrowing capacity is. So you may be able to use the increased equity in now to go and buy another investment property if that's part of your plan. And if you've got enough borrowing capacity, it depends on what your limiting factor is, whether your limiting factor is equity and savings, which we need for a deposit, or is your limiting factor borrowing capacity, which you need to fund the rest of the purchase. So you don't really want to, if you're adamant on developing, I'd probably ask myself the question of, why am I going to get a better return, and look at the returns from developing. Are you going to keep that, what you develop, and rent it out ongoingly, and that's going to also form part of your portfolio? Or are you doing it to chunk up money and help fund your next deposit to purchase something else? Are we going to roll those things forward, or are you going to do part of keep part of it and sell part of it with what you create? So if you're, depending on whether it sounds like you've got enough equity and savings to contemplate another purchase, potentially enough in there to also do a development. If you can make that other purchase and you'll have enough borrowing capacity in a few years' time to do the development as well, then this comes back to your larger plan too. So you might be able to have your cake and eat it too. So the property that you buy in the meantime, it's likely to go up over the next 12 to 24 months. That's going to likely give you more equity that you can also use towards funding this development, providing that you can have enough borrowing capacity in the future to do it too. So you can project your income forward in your plan, look at, are you going to have any bigger increases to your income over and above inflation? Is that going to help you sort of step into another borrowing capacity level? And are worth thinking about those things as well. So hopefully that helps you decide what you might be able to do in the meantime. If all of that's not possible and your borrowing capacity is really limited at the moment, other options are that I guess you could potentially look at joint venturing with someone to develop the property. You could potentially focus on your job and income to try and get your borrowing capacity up quicker in the meantime. And those are some suggestions. So good luck with things. Next question. What are the various metrics used to assess investment property performance besides yield on purchase? And yield is the annual rent divided by the purchase price. And in Perth, it's anywhere from, say, 4% to 7% for units. And there's usually a bit of an inverse relationship. So the higher the rental yield, the lower the sort of expected growth. And I typically find that the total return comes out to about 10%. So if it's higher yield at 7%, it's often around 3% for growth expectations over the long term. And likewise, if you're buying at a 3% yield, the capital growth expected is more 7% over the longer term. That said, in the shorter term, different asset classes and property types are going to jump and revert back to their longer term sort of growth rates. And I did mention that the middle's looking undervalued, the units are looking undervalued, and the top end's looking undervalued now relative to the lower end. And the person's asked here, how do you use this to decide to keep or sell? So I guess they're deciding, does this property form a part of their portfolio ongoingly? Is it a good investment? I think it's a good question to ask. So when I do our strategic portfolio plans, we do what we call a trifecta review of a property, where we look at the suburb, how that's performed in the past. We look at what's the short-term outlook for growth, what our prediction tools are telling us is likely in the shorter term. We look at how strong that potential is as well. So John covered in his seminar some really good sort of metrics as well. We're going to add into the mix to review the likelihood of strong growth in a suburb. And you can look at how this fits into your overall portfolio and really decide on the reason for selling. So I think if you've got a larger strategic plan to things and you review what the contribution of this individual property is likely to be, you can then decide, is it a keep for the shorter term or keep for the longer term property? And you can have some properties that are more tilted towards that rental yield and providing you more income towards that cash flow goal. And then you can have other properties that are more tilted towards growth and building your asset base and giving you enough equity to have other choices as well. So happy to give you some specific feedback if you reach out. We also have we can do an individual property review for someone, and we can also do our strategic portfolio plan for someone overall to see how it fits into the mix. So get in touch if you think we can help. Next question, tips for the first time investor, please. That's a pretty open and broad question, but I'll give an answer for where to start, because I think back to when I read my first book, Rich Dad Poor Dad, at age 16, getting a smile on my face just thinking about it. So I do reread the book every couple of years, and I get new meanings, and it's awesome to sort of look back at how that inspiration has motivated my path and how far I've come as well. So it's really cool to reconnect with the book. But get educated, read that book, read lots of books. The more that you can add into the mix, you can sort of condense that down to your overall investing philosophy and understanding. You can see who resonates with you. I'd listen to podcasts. Hopefully you're listening to this one right now. I'd build a team of professionals, and the key for that is looking at people that have got personal investing success and experience, and birds of a feather flock together. So, I'm going to have a really great accountant, finance broker, settlement agent, building and pest inspectors, because I've gone about finding the very best to work with me and my team on the property management, strategy, buyer's agency, and selling sides of things. So if you find the right team, you can then go about creating an overall plan. And this can be, I'd prefer to have, if I was starting again, I'd love to just have this plan from the beginning. It's not like you set your plan, never forget about it. Never change it and just forget about it. You review it each year. Things change. Your goals will change. And what you think is possible for your own future will change. So that's going to open up a whole world of possibilities where you need to revisit your plan and decide, are these properties going to get you there? Do I need more? Do I need to reshape what's in my portfolio for your new goals each year? So get in touch if you think a strategic plan will work, and we can certainly help with the execution and the team. And I'm sorry, but you're the only one that can get educated for yourself. I'm here to help on that front too, so tune into more of the podcast. Good luck. Now, next question. Looking at feedback from agents, brokers, and property valuers, how are bank valuations on property purchases faring against what this person's calling inflated prices some properties are fetching at the moment, and how is this affecting loan approvals? So, good question. I've been pushing asking prices on all the properties that I'm selling, and with so few on the market and so many buyers who have often just missed out on another property, they come in all guns blazing, and in just about every case, properties are selling for more than their asking price. And even last weekend, for instance, I had properties asking between 500 and 750, 450 and 750. And I sold one of them for 90,000 above asking, one of them for 102,000 above asking, and the other one for 100,000 above asking. So nearly 100,000 average above the asking price, which is crazy. So that's also obviously to do with how I go about creating competition, getting people to pay a more emotional price and get that fear of missing out. And it makes a big difference in the prices that I'm getting. So take the case where, an average agent who doesn't have an overall strategy for getting the best price, and I've run through in a different podcast episode previously what my strategy is with its 5 sort of points. But you can imagine that a seller may still be happy, getting 20 or 30,000 over, but they don't know how much money has been left on the table if they just had a really great sales agent to strategically approach their sale and really drive the price up to a more emotional one. So there's certainly times when I've been worried that the price that I've got, are the valuers going to value it at contract price? Are we going to have a problem here? So in my experience over the hot market over the last few years, valuers have been very understanding of how things are out there, and they're keeping pace with things, and they are more looking to what is under contract, not what sold 2 to 3 months ago and settled, because anything that's not current and not now is dated, and the market can gap up very quickly on where the prices are. So there's been a few times when I've had to talk a valuer through the level of interest that I've had, what other offers I've received. I'm really trying to substantiate the valuation to come in at contract price and make them feel better about valuing it there. So I haven't had any fallover on finance despite selling them for significant amounts above asking. I have had to certainly substantiate things to quite a few valuers, and a good sales agent will know how to do that and how to really fight for the valuation to come in at contract price so you don't get any hiccups. Now, let's say that the valuation doesn't come in at contract price. I think buyers need to also understand that that's a possibility and have some other equity or deposit to use to bridge the gap on things, knowing that they could look at refinancing in 6 months' time. Things are going to be much higher still, so they could then pull out the extra money that they've had to put in to bridge the gap. And I still wouldn't let that deter me, but if I was a buyer, I'd really be looking through to where is the market at, and was there a depth of interest around the property that you bought? And if there is 3 or 4 other buyers that are all willing to pay the same, then that's where the market's at. And you should be willing to pay that if you are looking at the right property and it fully stacks up. Cool. So that's another episode. I hope you've gotten something out of these questions. Would do me a favor and post a review if you've enjoyed this episode. Share it with some friends. It really makes a massive difference to me and the show. So I look forward to catching you on the next one. Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.